If you already own a home or an investment or an asset, this budget doesn't really affect them, so why would they ever sell their asset, you know? And then for new buyers, it's like, now I lose those benefits if I buy it.
I'm terrified though of the future. It doesn't seem to be getting any better. I'm a single mum on a pension. There's no way for me to own a home.
I don't understand how this is going to free up properties for the younger generation.
Every day since the budget, someone has asked me the same thing. So what should we actually do? And I get it. You've read the changes. You now understand the new negative gearing and CGT rules. But knowing what changed and knowing what to do about it are two very different things. So I want to walk you through how I'd think about it, the questions I'd want you to answer with your partner, the traps I see people fall into, and the philosophy I'd bring to your dinner table. Because what do I do now depends on two things. One, which market you're buying and or selling in. And two, which of the 4 buy types you are in. Before we jump in, this is part 3 of the budget series. Make sure you watch part 1 and 2 first if you haven't done so. So before anything else, let's get into which market you're in, because it changes everything. There is no national property market. There's no Sydney housing market. There's not even a single Northern Beaches market. You might split it into lower, middle, and upper areas. But within that, you've got entry level, forever, and premium homes. You must even go deeper into the pockets locals love and the ones they avoid. Even within a street, varying pieces of land, changes in aspects, buildings, views, privacy, they all move differently. Look at what's happened since 2019. Perth is up 137%, Brisbane around 130, Adelaide 120, Sydney 65, and Melbourne 31%. But go deeper than the city line. In Sydney alone, houses and apartments have moved at completely different rates. So has a boutique pocket versus a high density one, the top end versus the bottom, new housing estates versus established. One city, one set of interest rates and outcomes nowhere near each other. You must always remember there are 11.5 million properties across Australia. They're all marching to their own beat. If you're in Perth, Brisbane or Adelaide right now, sit with this. You've been on an enormous run. Confidence was through the roof. Prices went from very affordable to a bit stretched. Every open home was busy and it has been constant. But buying in 2026 is a different thing from buying in 2025 and a very different thing from 2019. If you're in Sydney or Melbourne, it's the opposite feeling. Prices have been much more constrained. Confidence is patchy. Open home numbers vary dramatically. Affordability is all over the place. So when you ask, what should we do? The answer depends heavily on which part of the market you're talking about, but also your family's life plan, your financial position, and how confident you feel in it, your other options, and your values. The philosophy I'm about to give you can work everywhere. There are 4 groups of people watching this, and I want to talk to each of you. First home buyers, you are now wondering whether to buy or wait. Upgraders, you are sitting in a home that you know is not for the long term, but unsure what to do. Current investors, you are asking whether the properties you own still make sense. And future investors, you are not sure what to buy or at all. First home buyers, we love working with you. We know how hard it is and we know how much it matters. So if you're watching this from your parents' place or from a rental, sitting on a deposit and wondering whether the budget changes your plan, I'd reframe the question. Is buying a property both a good life and a good financial decision? I see the same thing too often. An early 30s couple, sick of rent going up, sick of being told to move again, parents, friends and colleagues in their ears, frustrated that they missed the last run. They see an opportunity and think this is the moment. They bought a unit near the city because it's what they can afford. They tell themselves that at least they're out of the rental market. The problem is, however, that they are solving the wrong problem. Getting out of renting matters for security, but the home they have bought fits their life today, often not tomorrow. The bigger questions are the ones you must slow down to ask first. Where do we want to live long term? Do we want kids? Do we want to be near family, near schools, near work? What does the next chapter of our lives actually look like? Because the property you buy today has to fit that answer. If it's clear that you want to be in the southern part of Melbourne, start a family, and work in the city for the next 5 and 10 years, then the case for buying rather than renting gets a lot clearer. But if the honest answer is, I don't know, I just want to be out of the rental market, you might be buying something that you have to sell, a weak asset in a market that may not grow, just to avoid the hassle of finding another rental. Whatever anyone tells you, I cannot make this more clear. It must be a good investment. If prices don't rise, you haven't just not made money, you've wasted a big chance on the wrong property. Buying your first home isn't about the price you pay or being able to say you're an owner. It's about finding a place that fits your life for the next 5 to 10 years and performs financially. It leaves you better off than renting and gives you more options down the road. The first property will likely never be your last. That's the advice we've always given, but without a doubt, it matters even more now post-budget. For years, investors competed for the exact properties first home buyers wanted. Post-budget, investor demand for established homes will collapse, meaning owner-occupiers are the main buyers and set prices. The budget has opened the door for first home buyers. It feels scary out there, but you may be able to buy a better quality asset than you could have for years. When an investor was outbidding you at every auction, something you can grow into, something the next owner-occupier will value the way you do. If that's on the table, it is a genuine opportunity for you to consider. But if you're only trying to escape renting, you might be trading one problem for a bigger one. Next episode, we will cover the options for first home buyers in depth. Now the upgrader. You already own a home, you've got equity, and you've probably got kids. And you've looked around your place and admitted it won't fit the next 10 to 15 years of your life. You know deep down you are going to have to move at some point. You've had the chats and you've kicked that decision down the road once, maybe twice. This is the group that I see most frozen right now. The market feels highly uncertain. Rates aren't rising, but they're not falling either. Sydney and Melbourne feel like they're going sideways or falling. While in Perth, Brisbane and Adelaide, they feel like they've had their big run. So the question sitting in the back of your mind is whether you regret not taking action in 2026. There are two very real paths here. Path one is that you can stay. You like your home, your neighbours, your suburb, you renovate, add a room and buy yourself another decade to get your kids through school. If that genuinely works, it's usually the cleanest answer. There's no pressure to move, just renovate. And the choice to upgrade depends on the lifestyle gains and financial benefit in doing so. Path two is you can't stay. The block's too small or the location's wrong for school and family. No renovation fixes that. So you have to sell at some point to move somewhere that gets your family through school and maybe even uni years if the kids stick around. So if part one doesn't work, you have to be honest with yourself because you're kicking it down the road again. And every year that you kick it, the risk on the market running on you also increases. And as your kids get older, so does the pressure to move. The window shrinks and the market timing matters more. The gap between your current home and the one that you want tends to widen. Bigger and higher quality family homes are often held for a long time. They rarely transact and they grind higher over time. Smaller homes tend to grow more slowly. They sell more and are more susceptible to market changes. The transaction cost of moving also gets larger. The gap between what you sell for and what you pay grows with them. So the question isn't, is now a good time to move? It's, can I realistically grow into this home for the next 10 to 15 years? And if not, is now the right time for our family to lock in our future? Upgraders often miss something in a market like this. When you sell in uncertain times, you also buy in them. You have to accept that you won't get the perfect price for your place. But you're not just selling, you're buying. And if you can find a bigger block in the right school catchment, the seller on the other side is nervous too. What matters is the gap between the two, not the price on either one. Sit with that. Prices stop rational brains making decisions. Where you end up, both in a financial sense and lifestyle, is what matters. In 2026, that gap will have narrowed because the top end has been softer for some time. Higher interest rates, tight borrowing capacity, and buyers sitting on their hands. The people selling the bigger home are more nervous than the people selling the smaller one. The pool of upgraders you're competing with is much smaller because most of them are doing what most people do in uncertain times, which is wait. Now, Perth, Brisbane and Adelaide might be a different story. Those markets have run hard and the upgrade gap has often widened. The window to trade up from your current home may have already closed. But in Sydney and Melbourne, it's the opposite. The upgrade gap is the most favourable since 2021. The top end has come off harder than the middle. The family in the $4 million house is more nervous than the family in the $2 million one. That's the window in a softer market and in 2026. How you actually execute it though, buying or selling first, bridging finance and managing risk, that's a whole episode on its own. We'll do it. Today's about the decision itself. Now the current investor. You own 1 or 2 investment properties, maybe more. You've been holding for capital growth. You've been offsetting the losses against your salary. And you've been telling yourself to stick to the plan, and it's working. Post-budget, that story must be checked. Your existing properties are grandfathered, so your negative gearing position doesn't change. You can keep deducting the losses against your salary. But being allowed to use negative gearing is different from knowing that holding is the right call. Because buy and hold isn't a strategy. It's a story investors tell themselves. The reason to hold an investment property is that it's the right asset for you at your stage of life, given your other options. Not because you've always held it, not because that was the plan, not because selling feels like admitting you got it wrong. There are 2.3 million property investors in this country. Roughly 2 million of those own 1 or 2 properties. It's ordinary households. The age split is where it gets real. Younger investors under 50 are often negatively geared. They bought to build wealth. So the question for them is whether this is still the right property to do that. And often it can also become an issue. Is the equity and the borrowing capacity tied up and holding them back from making other moves? For example, buying their first home or holding back an upgrade. The question to ask is, would you buy this exact property again at today's price if you were starting fresh? And if not, what's your alternative? You must be asking these questions constantly. No property decision is set in stone. And if you're in your 50s, the alternatives to residential property look better. Your equity is usually larger, the cash flow is often positives, and future capital gains tax becomes a bigger factor. Plenty of investors own genuinely good assets that are now even more desirable, but plenty don't. You now understand that from 1 July 2027, the CGT concessions will change. So you have to look at the alternatives honestly. Paying down your mortgage is a risk-free after-tax return equal to your interest rate. So at 6%, that's like earning 9-10% pre-tax in shares. Superannuation is another. Non-concessional contribution and bring forward rules may allow a couple to contribute up to $780,000. Earnings are taxed at 15% in the accumulation phase and potentially not at all in the pension phase from 60 onwards. This comparison to holding highly taxed, low-yielding property after 2027 gets uncomfortable. And now that the budget has shifted deductibility, sometimes the right move isn't completely out of property. It's buying an investment property, a home that you'll actually retire into. The point isn't that you should sell. The point is that you should look at what else that money could be doing. There's a temptation right now to hold for the 2028 election. If the government changes, maybe some of this gets reversed. I get the logic and it may well happen. However, holding an asset in the hope of policy reversal is a decision. If you're getting close to retirement, the alternative options to residential are always on the table. The thing I'd really want to know is your local market. How many properties like yours are for sale right now? How long have they been sitting there? Are they selling strongly? Are they passing in? How deep is the buyer pool? Who is the next buyer? Because your ability to sell an investment property comes down as much to the market as your decision. If your patch is thin and slow, the window to exit may have already passed. You may feel like you've missed the boat, but still decide it's the time to sell. So in summary, for a current investor, check the quality of your asset, not the story you've been telling yourself about it. And given your age, your assets, your retirement plan, and the local market with your alternatives, is this the right property to hold? If yes, great, you've made a decision. If no, consider your exit. It won't be tomorrow. Selling property requires planning. Now, the future investor. You've got equity in your home or a deposit saved. You've been thinking about buying your first investment property or another. I'll be blunt, the strategy has changed for most investors. The budget changed the decision for new investors in 2 ways. 1, if you buy an established property after budget night, from 1 July 2027, your losses can't be offset against your salary. So you have to fund the negative cash flow out of your after-tax income, or buy something much closer to neutral on day 1. 2, the new CGT regime, cost-based indexation, plus a 30% minimum tax on the gain. It hits hard when you buy and sell over shorter periods. So you must be more confident in growth, because every dollar of growth from 1 July 2027 sits under it. To be fair, new builds are treated differently with full deductibility of ongoing losses. But investing in new property has always been challenging. Quality properties are scarce and almost impossible to buy. Developer margins are baked in. More properties like yours are likely to be built. Off the plan brings settlement risks, sinking fund issues, and body corporate headaches. It looks great on the budget fact sheet, but for new investors, it is a lot harder in practice to justify, even with attractive tax treatment. So what does a future investor actually do? I want to be careful here because we are still figuring this out client by client. What is the right strategy? What do we buy? How do we structure it? It's a case-by-case situation, but the principle matters. Before the budget, you could get away with keeping it simple. Buy in your own name, negative gear, ride a known CGT discount at the end. Post-budget, that offset is locked away for some time on established property, and the CGT on future gains is heavier, which means every dollar you invest each year or lose to poor structuring matters. The future investor has to get 3 things right before they sign anything. 1, the property. Is it genuinely a good asset, or is it just a tax-driven or comfortable purchase dressed up as one? 2, the structure. Whose name is it in? Your own, a trust, a company? The wrong answer costs you in this new world. Get advice from an accountant who specializes in property, not from a mortgage broker's YouTube channel. 3, the cost to hold. How do you afford to carry it in the longer term? When would you want to sell? Are there better alternatives? Is the risk, borrowing capacity and cash you're tying up worth the after-tax reward? If you can't answer all 3 before you sign the contract, don't invest. Property growth from here will reward patience and structure. We'll go deep on all of it in future episodes. We'll get into the strategies, the structures, and the range of scenarios you might be weighing up. Today, the point is just the way you invest has changed, so your strategy has to change with it. Finally, I do want to highlight a 5th group, Australians who won't ever buy because they can't, or they've chosen a different life, or the ladder simply never opened for them. There's a separate episode, and if that's you, none of this is telling you that you failed. We know the system has failed many, and we will discuss that in future episodes. So where does that leave you? Start with the market you're standing in. Where do you actually want to live? Is this the right asset for where you're going? What are the alternatives? If you sold, what would you do with the money? The budget doesn't answer any of that for you, but it does change strategy behind every one of those questions. If you want us to look at your specific situation, that's what we do every day. There's a link below to talk it through with the team. No pitch, just a conversation about where you're actually at. And over the next few episodes, we're going to go deeper. The lending strategy options for first home buyers, upgraders, and investors. I'll see you on the next one.